If you have money in the bank, either in a checking account or a savings account, your hard-earned money is losing value every single day thanks to inflation. Wouldn't it be better if you could receive a decent return on your capital, let's say at least 5%, without risking losing your money, with no hassle, and getting access to your cash whenever you want? Well, that's where T-bills come into play. In this video, you'll learn everything you need to know about T-bills. So let's dive right into it. I bet you're thinking, what are T-bills? Well, T-bills are short-term debt securities issued by the US government. Basically, it means you're lending money to the US government. And T-bills are used by the US government to continue funding their projects and programs. T-bills are one of the safest investments out there because they're backed by the full faith and credit of the US government. Unlike bonds, T-bills have no periodic payments at all. Instead, they're sold at a discount to their face value. So for example, let's say you buy $1,000 of T-bills. You will probably purchase that at a discounted price of $980, for example. That $20 difference represents the return on your investment. For a moment, let's take a step back and look at the bigger picture. In an ideal world, we would want to choose an investment which has high return, so we make a lot of money, has low risk, so we won't lose money on our principal investment, and has high liquidity, meaning we can cash it out as fast and easy as possible. But we live in the real world. In the real world, you can choose a maximum of 2 of these, and you would have to sacrifice the third one. Stocks have a solid long-term return and they're really liquid, but they are pretty risky. You can easily lose 30% or even more of your investment in just 1 year. Real estate investing, if done correctly, also has a pretty good return, especially if you can get a low interest rate mortgage. And it's a relatively safe investment. It's not very liquid though. It takes a long time, several months, to sell a house, and the selling process comes with considerable transaction costs. Saving accounts and T-bills are very safe and liquid investments. On the flip side, their returns aren't as great as stocks and real estate in the long term. So why would we want to buy T-bills? Let's say, in the near term, you're going to need a considerable amount of cash. Let's say you're saving for a down payment for a home you want to buy in the next 2 years. In that case, you don't want to risk losing money. But at the same time, you want to get a decent return on your capital. In that case, T-bills probably make a lot of sense. I personally own a substantial amount of T-bills for these reasons. Are there any risks with T-bills investing? Well, one source of risk is you buy T-bills and the US government defaults on its debt. That is very unlikely, and if that happens, we're going to have way bigger problems than just your personal investments. Another source of risk is you buy T-bills and you want to liquidate them, sell them before their maturity date. If the interest rates have risen since the time you bought the T-bill, your T-bill is less favorable now, and if you want to get rid of it and sell it, you would have to sell it at a bigger discount, so that would probably mean a loss. On the flip side, if the interest rates have dropped, your T-bill is more favorable, so you can sell it at a profit. You can minimize this risk by just buying T-bills with shorter maturity, such as 4-week T-bills. You may have also heard about Treasury notes and Treasury bonds. How are they different than Treasury bills? The main difference is the maturity dates. Treasury bills have the shortest maturity dates from 4 weeks to 52 weeks or 1 year. Treasury notes have maturity dates of 2 years to 10 years, and Treasury bonds have maturity dates of 20 years or 30 years. Treasury notes and bonds provide interest payments every 6 months, but Treasury bills don't. And with the Treasury bills, your return on investment is based on the discount you get when you buy those T-bills. Are you thinking, why would we choose T-bills over saving accounts and CDs? Well, first of all, at the time of recording this video, the interest rates T-bills offer are more than saving accounts and CDs. Second, you get a tax advantage with T-bills. T-bills are exempt from state and local taxes. That's a big deal if you're living in these high tax states like New York or California, but you may care less if you're living in these states with no income tax like Texas and Florida. But with CDs and saving accounts, you also have to pay the local and state taxes. And third is with liquidity. Saving accounts are very liquid, just like T-bills, but with CDs, you're basically locking your money for a certain amount of time. If you withdraw early, you typically have to pay a penalty. Are you thinking how stocks compare with T-bills? Well, I got you covered. Both T-bills and stocks are very liquid investments. You can sell them very easy and fast. T-bills are way less risky and have way less volatility compared to stocks. You may be even surprised to know that since 1928, there have been 3 extended periods of time where T-bills have outperformed stocks. I'm talking on the S&P 500. And that is mainly because stocks took a big nosedive in those periods. On the flip side, stocks have a way better long-term return. If you invested $100 at the beginning of 1928 in T-bills, you'll have $2,140 by the end of 2022. On the other hand, if you invested the same amount, $100, at the same time, beginning of 1928, in the S&P 500, by the end of 2022, instead of $2,000, you would have more than $624,000. If you don't believe me, just check the link in the description below. So, stocks have phenomenal long-term returns, while T-bills barely keep up with inflation. There are 3 ways you can buy T-bills. The first approach is to buy them directly from the US government website, Treasury Direct. The main advantage of this approach is that the minimum investment is just $100. The second approach is to buy them through brokerage accounts like Fidelity, Charles Schwab, and Vanguard. You can buy either newly issued T-bills or buy the older T-bills on the secondary market. The main advantages of this approach is that selling the T-bills before maturity is super easy with just a click of a button, and you can buy the T-bills in Roth IRAs and other retirement accounts if you wish. But the minimum investment is typically $1,000. Absolutely no fees though. The third approach is by purchasing them through ETFs. You would want to pick an ETF with a reasonably high assets under management, trading volume, and minimal fees. With this approach, you are paying a small amount of fees, but you don't have to worry about which T-bills to purchase. There you have it. Now you know everything you need to know about T-bills. Go ahead and purchase T-bills with the idle cash you have sitting in the bank. Of course, after doing your own due diligence. I hope you found this video helpful. If you got any value from this video, don't forget to give it a thumbs up, comment below on your thoughts about T-bills, and subscribe to our channel if you haven't already. Thanks for watching and see you next time.